This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup. The week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome back to the Deep Dive. And hey, a really special welcome today to all of you, our dedicated listeners from the Wire community.
Yeah, great to be talking with you all.
We know you're out there, right on the front lines, navigating the complex, often unpredictable currents of the real estate market every single day.
Absolutely. It's a dynamic environment, that's for sure.
You're the top performing, experienced agents and brokers, the ones who thrive on being ahead of the game, not just, informed.
Mm-hmm.
So for this deep dive, we've really tailored it specifically for you. Our goal today is simple. Cut through the sheer volume of news from this past week.
There's always so much noise, isn't there?
Exactly.
Yeah.
We want to distill it down into the critical insights you actually need to truly stay ahead of the curve.
Absolutely. Think of this as your essential briefing for the week. We've meticulously gone through, a whole stack of sources, articles, research papers, market analyses, even some of our own notes. And importantly, this is all fresh, published just in the last week, roughly July 21st through the 26th.
Right. Hot off the presses.
Our mission here really is to pull out the most important nuggets, the surprising facts, maybe, and definitely those truly actionable takeaways.
The stuff you can actually use.
Exactly. The things that can genuinely inform your strategies and, maybe motivate your next moves. We're not just summarizing here.
Okay.
We're analyzing, trying to connect the dots, and really give you the so what for your business. What does this all mean on the ground?
That's exactly right. So we're going to dive deep into three critical themes today. First up, we'll unpack the political and economic currents shaping real estate.
Okay.
We're talking everything from proposed policy shifts, some potentially game-changing ones, to the Federal Reserve's ongoing influence on those all-important mortgage rates.
Always a big factor.
Always. Then second, we'll navigate the shifting sands of market supply, demand, and price. We'll get into the latest data on inventory levels, sales volumes, and the ever-evolving dynamics between buyers and sellers.
That's where things get really interesting, often contradictory.
Oh, definitely. And finally, number three, we'll shift gears to strategic evolution for real estate professionals and investors.
Mm-hmm. A practical side.
Exactly. Highlighting essential survival strategies, maybe some technological advancements, and new opportunities that are emerging in this incredibly dynamic market.
Sounds like a plan.
So if you're ready, let's get right to it and start unpacking what's been happening.
Let's do it.
Okay, let's kick off with what's arguably been making some of the biggest waves, certainly in the economic and political spheres this past week.
Uh-huh.
I'm talking about that buzzing conversation around potential tax changes coming out of the political arena.
Yeah, that definitely got a lot of attention.
And look, this isn't just theoretical policy talk, right? This stuff directly impacts your clients, their decisions about buying or selling, and let's be honest, ultimately, your bottom line.
Absolutely. Big potential implications.
We're pulling insights here from articles published as recently as July 24th and 23rd, so this is really current, incredibly relevant right now.
Right. So what's fascinating here, and I think immediately polarizing, is the discussion sparked by former President Trump's recent comments, specifically regarding a capital gains tax on home sales. On July 24th, Real Estate News reported that Trump hints at July rate cut, Fed will do the right thing. But then that kind of evolved into a much more direct statement.
More direct how?
Well, CNBC picked it up on both July 24th and 23rd, with the headline basically being, Trump, no tax on capital gains home sales.
Wow. Okay, no tax. That's a big statement. What does that actually mean in practice?
Well, to be clear, the proposal, if it were implemented, suggests the complete elimination of capital gains tax on the sale of a primary residence.
Completely eliminated.
Yeah.
Because right now there's an exclusion, isn't there?
Exactly. Currently, for a single filer, you get an exclusion up to $250,000 in capital gains. For a married couple filing jointly, it's double that, $500,000.
Right. Provided you meet certain conditions, live there to the last 5 years, that kind of thing.
Correct. Trump's proposal, as stated, goes way beyond that. It suggests a full removal of the tax on those gains from your main home.
Okay. So for homeowners, especially those with a lot of equity or even investors, what's the potential impact there?
Well, potentially huge. For real estate investors and really for any homeowner sitting on significant appreciation, this could be a massive incentive to sell. As BiggerPockets highlighted on July 23rd in an article titled What Trump's Housing Plan Could Do for Real Estate Investors, removing this significant financial disincentive could potentially unleash a wave of previously locked-in inventory.
Locked-in inventory. Explain that a bit more.
Think about a homeowner who bought their property, say, decades ago for maybe $150,000. And maybe now it's worth, let's say, $800,000.
Big gain.
Huge gain. Even after using their current $250K or $500 A exclusion, they might still be looking at a pretty substantial tax bill on the remaining capital gains.
Right, which might make them hesitant to sell, especially if they're thinking about downsizing or maybe moving somewhere else.
Exactly. That potential tax hit can be a major deterrent, but if that tax burden were entirely removed, as proposed, it could dramatically change their calculation.
It makes selling much more attractive financially.
Precisely. It could encourage them to finally put that property on the market, and the thinking is this could, in theory, help alleviate some of the current inventory shortages.
Particularly for those long-held homes.
Yes, and potentially inject some much-needed supply into those local markets where, you, our listeners, are maybe struggling to find listings for your buyers.
Okay, that sounds, incredibly impactful on the surface. Like you said, a potential wave of new inventory. Almost sounds too good to be true in some way.
Well,
because I know the moment this idea was floated, there was immediate skepticism, right? A really strong counter-narrative popped up pretty much instantly.
That's right. There was definitely pushback.
So what were some of the nuances? What were the critical counter-arguments that other sources were quick to highlight? Why do they argue it wouldn't be the magic bullet for housing?
Precisely. And that's the key phrase, magic bullet. While the headline, no capital gains tax, sounds incredibly appealing, many critics jumped in immediately to point out why it might not be the panacea for the housing market.
Okay.
So CNBC, for example, on July 23rd, ran an article titled, Why Cutting Capital Gains Tax on Home Sales Wouldn't Solve Housing Issues.
Right.
And that was echoed in a CNBC video from July 22nd featuring Redfin's chief economist, Daryl Fairweather. Both basically argued that this proposal, while interesting, wouldn't address the underlying housing problems that are really plaguing the market today.
And what are those fundamental problems, according to the critics?
Well, the core issues, they contend, are really deeply rooted in persistent supply shortages at the foundational level.
Meaning just not enough homes being built.
Exactly. We simply don't have enough homes being built overall, and critically, particularly, not enough affordable ones. And then there were the broader affordability challenges that go way beyond just capital gains tax for sellers.
Like what?
Well, for instance, critics highlight that high interest rates, which directly impact a buyer's monthly payment, they continue to be a significant barrier for most people.
They're a barrier.
Huge. Then you have rising construction costs, driven by things like labor shortages, material expenses that make it expensive to build new homes.
Right.
And, really critically, limited developable land. This is often made worse by zoning restrictions and, local opposition, the whole NIMBYism thing, not in my backyard.
Yeah, the NMB factor is real.
It is, and all those things contribute to affordability issues that wouldn't just magically disappear with the tax cut on existing homes.
So the argument is, this tax cut mainly benefits sellers of existing homes.
Correct.
But doesn't necessarily incentivize the construction of new supply or directly lower the cost of housing for buyers.
That's the core of the counter-argument. So if you're an agent listening, yeah, it might free up some listings, which is good, but it doesn't necessarily solve the deeper problem of a lack of homes that are truly within reach for the average buyer you might be working with.
Okay, that makes sense. It addresses one side of the equation maybe, but not the whole picture. What about the market reaction? Did Wall Street weigh in?
Oh, yeah. The fast money traders on CNBC video, also on July 22nd, they reacted immediately. And their concerns were largely centered on the potential for, market volatility. And whether a policy like this would truly translate into broad affordability improvements, or if it would just be, say, a short-term boost in transaction volume, maybe mostly for higher-priced homes.
Right. Would it just help the wealthy sell expensive homes tax-free, or actually help inventory at lower price points?
That was the question they were raising. They questioned if it would genuinely address the inventory drought where it's most acutely felt at those lower and middle price points.
Okay.
So the takeaway here is, while it's politically significant, definitely attention-grabbing, it's just crucial for you, our listeners, to understand that the real estate market is this incredibly complex ecosystem.
Right. So many moving parts.
Exactly. Influenced by a whole myriad of factors. A single tax policy, even a really major one like this proposal, often only addresses one facet of a multidimensional challenge.
Just definitely not a silver bullet for the entire housing crisis.
Not according to the critics. And its real-world impact, if it ever happened, would likely be far more nuanced than the headline suggests.
That's a really important distinction to make, understanding what it would solve versus what it wouldn't. Okay, and speaking of broader economic factors that aren't silver bullets, but are hugely influential, we absolutely have to talk about the Federal Reserve.
Always. The elephant in the room sometimes.
Right. Their decisions directly trickle down to the mortgage rates that our listeners' clients are seeing every single day when they talk to lenders. What's the latest on the Fed's stance, and what's it mean for rates right now, on the ground?
Yeah, the Fed continues to be this central, almost gravitational figure in the whole economic landscape. And they're maintaining what they often refer to as a delicate balance.
Delicate balance, meaning?
Meaning balancing their goals. CNBC reported on July 25th that the Fed likely to hold interest rates steady despite Trump's pressure.
Okay, holding steady despite pressure.
And that phrase, despite Trump's pressure, isn't just a passing comment. It really underscores the Fed's deep-rooted independence from political influence, or at least their assertion of it.
Right, they have their own mandate.
They do, a dual mandate.
Right.
Achieve maximum employment and maintain price stability, basically, keeping inflation in check.
And balancing those two can be tricky.
Very tricky. It often means making tough decisions that aren't always politically popular. And they seem willing to stick to their guns, which is likely why we're seeing them resist calls for immediate, significant rate cuts right now.
Okay, so they're holding steady. What does that actually look like in the mortgage market day to day? What are the reports saying?
Well, what we've observed in the mortgage rates today, reports from the mortgage reports looking across several days, July 25th, 24th, 23rd, 22nd, is a general sense of stability. Or at most, very slight fluctuations.
No big swings up or down.
Not really. There haven't been any dramatic shifts downwards, for example, which is what many buyers are hoping for.
Right.
This steady state, or maybe you could call it a lack of significant downward movement, is directly what agents like you are probably experiencing on the ground. Rates are kind of stuck in a range.
Yeah, that feels familiar. Bit of a plateau.
Exactly. And the market is very much in a wait-and-see mode regarding the Fed's next move, especially with their upcoming meeting.
When is that? Is there a preview out?
Yeah, the mortgage reports had a mortgage rates July 2025 Fed meeting preview out on July 22nd. And it reinforces that market watchers are keeping a very close eye on the Fed. Most analysts at this point expect them to hold steady for a bit longer.
Okay. And how does this rate environment affect actual borrowing activity? Are people applying for mortgages?
That's the direct link. The weekly mortgage application volume report from CNBC on July 23rd illustrates this connection perfectly. Borrower activity is incredibly sensitive to these rate movements.
Makes sense. A small change can mean hundreds of dollars a month.
Exactly. So if rates remain relatively stable, like they have been, it often translates to more consistent, or is it perhaps not surging, application volumes.
People aren't rushing in, but they're not completely holding back either.
Kind of. It means buyers and people looking to refinance are less inclined to, say, rush into decisions triggered by a sudden rate drop, or maybe hold back entirely because rates are spiking wildly.
So it leads to that tepid level of activity we heard about with new home sales earlier.
I think that's a fair connection. This consistent, maybe somewhat subdued level of activity implies that while the market isn't completely frozen, it's certainly not experiencing the rapid, frenetic pace we saw in previous years.
And for our listeners' clients, what's the implication? What kind of mindset does this foster?
It translates into a need for very clear-headed decision-making in the current environment. You can't just assume rates will plummet tomorrow.
So what does this all mean practically for our listeners on the ground? Dealing with buyers and sellers every day, it sounds like it means continued vigilance on rates, right?
Absolutely vigilant.
And really understanding client psychology around, should I lock in now or should I wait?
That's a huge part of the agent's role right now. It's not about advising clients to wait for some huge transformative rate drop that, frankly, may never materialize in the short term.
Yeah, banking on that seems risky.
It is. It's more about helping clients make confident decisions within the existing reality. What's the most crucial piece of advice for agents navigating this environment?
Good question.
I think it's that agents need to be acutely aware of every fractional movement in rates, often literally tracking them daily, and be prepared to guide their clients through that decision-making process with a calm, data-driven approach, not reacting emotionally to every little blip.
Right. Manage the anxiety.
Exactly. The current stability, or maybe more accurately, the lack of significant downward movement, means that the wait-and-see approach from buyers hoping for dramatically better rates, well, it might not yield those results anytime soon.
But manage expectations.
Definitely. This puts the onus squarely on you, the agent, to clearly articulate the current market conditions, help buyers understand the real implications of present rates on their monthly payments, their overall affordability.
Don't let them chase a ghost.
Right. Rather than letting them perpetually chase a lower number that might not materialize for many months, maybe even longer.
What about that idea of marry the house, date the rate?
Mm-hmm.
Does that still apply?
I think it's more relevant than ever. For clients who are on the fence, explaining that concept, buy the house you love now, potentially refinance later if rates do drop significantly, that can be a powerful tool.
It gives them some sense of control or future option.
It does. And it also makes locking in a rate when a client finds a payment they're comfortable with and can afford a really crucial piece of advice in this environment. Don't get too greedy waiting for that extra eighth of a point.
Right.
And this requires you, as the agent, to have strong relationships with trusted lenders who can explain the nuances clearly.
Understand rate locks, float downs.
All of that. And be able to explain those market factors in a way that empowers your clients rather than just overwhelming them with jargon.
So it boils down to helping them make the best possible decision today, given the information we actually have.
Exactly. Rather than waiting indefinitely for an uncertain tomorrow.
All right, that's a really comprehensive look at the macro forces, the politics, the Fed, the rates. Now, let's pivot from those policy discussions and truly dive into the nuts and bolts of the market itself.
Okay. Boots on the ground time.
Yeah, exactly. Supply, demand, pricing, dynamics, the stuff you're experiencing every single day. And this is where things can often feel, well, frankly, contradictory.
Oh, yeah.
And the reports from the past week definitely highlight that complexity. It's not a simple story out there.
Not at all. And this is actually where we uncover one of the most surprising and maybe counterintuitive insights of the week.
Ooh, okay. Surprising insight. Let's hear it.
It comes from Zillow. Their report on July 21st had a stark title. For sale signs multiply. Inventory hits 5-year high. Price cuts surge.
Wow. 5-year high on inventory and more price cuts. That sounds significant.
It is. A significant, measurable increase in available homes for sale, reaching levels we haven't seen in half a decade. And it's accompanied by a noticeable surge in price reductions.
Okay, so traditionally, historically, that signals what? A shift towards buyers.
Typically, yes. In a historical context, more inventory plus more price cuts usually signals a clear shift towards a buyer's market, more negotiating power for them.
Okay, but you said counterintuitive. What's the contradiction?
Well, almost at the same time, CNBC reported on July 23rd that June home sales drop as prices hit a record high.
Wait, okay. So inventory is surging, price cuts are surging, sales are dropping, but prices are still hitting record highs.
Exactly. That's the puzzle.
How does that even work? How can all those things be true at once?
It demands a closer, more granular look because you're right. It's not a simple story. There isn't one single explanation.
Okay, give us some theories. Why the apparent contradiction?
There are a few compelling reasons that could explain this complex dynamic. Firstly, that record high, average, or median price, it might be getting skewed.
Skewed how?
By persistent demand in certain segments, particularly maybe the luxury market or those highly desirable, perpetually supply-constrained urban or suburban areas.
High-end sales are pulling the average up.
Potentially. Those high-end sales, which might still be commanding top dollar, can pull up the overall average price, even if activity in the middle or lower segments is slowing down.
Okay, that makes sense. What else?
Secondly, the surging inventory. It might not be the kind of inventory that most buyers are looking for, meaning it might not be the affordable new homes or the well-maintained mid-range homes that many first-time or move-up buyers are desperately seeking.
Ah, so the inventory increase could be concentrated at higher price points.
It could be, or perhaps it's concentrated in areas with less robust demand overall. And that's where you're seeing the price cuts on properties that were initially overpriced for that specific segment or location, or where the buyer pool is just smaller.
So cuts are happening on, say, a $1.5 million house listed at $1.7 million.
Right.
But the median price of all homes sold, especially if the top end is still strong, could still be climbing.
That's a very plausible explanation for the seeming contradiction.
Okay. Is there data backing up this shift in market feel beyond just inventory numbers? Like, how are agents experiencing this?
Yes, absolutely. Real Estate News on July 23rd published results from a survey stating that nearly half of agents say local markets favor buyers.
Nearly half. That's significant. So it's not just abstract data points.
No, this is tangible, on-the-ground experience reported by real estate professionals like you who are listening. If you're out there feeling like your buyer clients have more negotiating power lately, this data supports that feeling.
And what's the consequence of buyers feeling more empowered?
Well, it links directly to another finding. As buyers gain leverage, more are backing out of sales, as reported by Real Estate News just a couple of days earlier on July 21st.
Okay. So buyers are getting cold feet more often or using contingencies to walk away.
Exactly. When buyers feel they have more options, they feel less pressure to commit immediately or overlook issues. Sellers might be more motivated to negotiate on repairs or price after inspections.
Right. Those contingency clauses suddenly have more teeth.
They really do. Buyers feel more confident walking away if the inspection isn't perfect, or maybe if they see a better deal pop up down the street while they're under contract.
So for our listeners, the agents, what's the takeaway here? Prepare your sellers for a different reality.
Absolutely. It means you really need to recalibrate your negotiation strategies. And crucially, prepare your seller clients for a different reality than they might have seen even just a few months ago when maybe buyers were waiving everything.
Yeah, those days seem to be fading in many markets. Here's where it gets really interesting for our listeners, though. This isn't just a slight adjustment, is it? This shift in leverage, where buyers are gaining noticeable power, feeling emboldened enough to back out of deals, that feels like a significant game changer.
I agree. It's more than just a minor tweak.
It feels like it fundamentally reshapes how you have to advise your clients, whether they're buying or selling.
It really does.
Knowing that nearly half your peers feel the market favors buyers and seeing buyers actually exercise that power by walking away, that completely reshapes the strategy you bring to the table, doesn't it?
It absolutely does. You have to manage expectations differently. Price listings perhaps more strategically from the outset, and advise buyers on how to leverage their newfound power responsibly.
Okay, so let's break down the sales figures themselves. We heard sales were dropping overall, but what about specific segments like new versus existing homes?
Yeah, let's drill into that. For new home sales, the numbers reported by CNBC Video on July 24th showed June figures came in at 627,000. That was actually below the expectation of 645,000.
Okay, so a miss versus expectations.
Right. And Ion Housing, also on July 24th, described it as new home sales hold steady at relatively tepid level.
Tepid. There's that word again. What does that really mean in context?
Tepid here is a key descriptor. It means sales are not robust. They're moving at a slow, sort of unenthusiastic pace. Exactly. It indicates that despite builders' efforts to increase supply, and they are building, demand isn't surging for new constructions at the current price points and, of course, current interest rates.
Builders are still facing cost pressures too, right?
They are still facing high material costs, ongoing labor shortages in many areas, rising land prices. All of that keeps the price floor for new homes relatively high.
Which makes them less accessible for many buyers.
Correct. So while new homes are coming online, they aren't necessarily solving the affordability crisis for the broad market, especially at the entry level.
Okay, that's new homes. What about existing home sales? That's the bulk of the market.
Right. And the picture there is equally telling, maybe even more so. Ion Housing reported on July 23rd that existing home sales retreat to 9-month low.
9-month low. Okay, that's a significant slowdown.
It is. It signals a noticeable cooling in transaction volume over the past several months. Fewer deals closing means fewer commissions for agents, practically speaking.
Yeah. Any other perspectives on existing home sales?
Well, a CNBC video on July 23rd, which was drawing from World Property Journal data, observed that June existing home sales were unchanged year over year.
Unchanged year over year. So down from the peak, but maybe stabilizing at this lower level compared to last year.
That seems to be the case. The market, while clearly not collapsing, isn't showing any significant recovery or growth compared to the same period last year either. It's kind of stuck.
And what's keeping it stuck? Is it still that lock-in effect we talked about?
That's widely considered a major factor. This stagnation in existing home sales often points directly to the lock-in effect. You have millions of homeowners sitting on mortgages with rates from, 2.5% to 4%.
Oh, those golden handcuffs.
Exactly. They're simply unwilling or financially unable to sell and trade up to a much higher rate, even if they want or need a different home. And that continues to choke off supply in the existing home market.
Which contributes to that paradox we discussed. High prices despite slower sales because the supply just isn't there.
Precisely. It's a key part of that puzzle.
Okay, so that's the current picture. What about looking ahead? Are there any forecasts for the rest of this year or maybe into next year? Any light at the end of the tunnel?
Yeah, there's definitely forecasting happening. Housing market forecasts for the rest of 2025 from Keeping Current Matters on July 24th compiled various perspectives. But interestingly, there seems to be a growing sentiment of, let's say, cautious optimism for the longer term.
Cautious optimism for when? 2026, maybe?
Exactly. For instance, UBS's John Lovallo was featured in a CNBC video on July 23rd, stating that there's growing optimism that the housing market will improve in 2026.
Okay, 2026. What's driving that optimism?
This forward-looking view suggests that while current conditions are definitely challenging and require really nimble strategies from you, our listeners, analysts anticipate a potentially healthier market down the road.
What would make it healthier? Lower rates.
That's likely the main driver in these forecasts. An expected flattening or maybe even a slight reduction in interest rates eventually. Perhaps an easing of supply chain pressures on builders too.
So the message is, tough it out now, but things might look better later.
That seems to be the general sentiment among many analysts, and this sentiment also directly influences investor strategies right now.
How so?
Well, Bill Smead of Smead Capitals was advising in a CNBC video on July 23rd to buy home builder stocks when sentiment is lousy.
Ah, the contrarian approach. Buy low.
Exactly. His rationale is that the current market headwinds facing builders, the slow sales, the cost pressures, might actually present a strategic entry point for investors who are betting on that future recovery we just talked about.
They anticipate that stock prices will rise as market conditions eventually improve and demand picks back up.
That's the bet. It shows that sophisticated investors are looking beyond the immediate challenges.
That's a really deep dive into the broad market trends and sales data. But, beyond the big picture, are there any specific niche market segments or maybe demographic trends bubbling up that offer unique insights, or perhaps even some untapped opportunities for our listeners to maybe specialize or explore?
Oh, absolutely. Drilling down into those specific segments is often where you find the really nuanced opportunities that the broader market data might just obscure. It's where specialization can pay off.
Okay, give us some examples. What niches are showing interesting activity?
Well, for instance, international buyers. Real Estate News reported on July 25th that a weak dollar spells opportunity for some foreign buyers.
Ah, the currency exchange effect.
Exactly. When the U.S. dollar depreciates against other major currencies like the euro or the yen, real estate here becomes relatively cheaper for those international investors or individuals converting their stronger currencies.
So you might see pockets of increased demand from abroad.
You could, particularly in those traditional international gateway cities, think Miami, New York, LA, or maybe popular vacation destinations. It offers a specific target market for agents who are equipped to work with international clientele.
Okay, interesting. What else? Lifestyle trends.
Definitely seeing persistent, maybe even growing demand for specific lifestyle choices. Look at gated communities.
Really? Still popular?
According to CNBC, yes. On July 25th, they had an article, Why Americans Love Gated Communities, and a companion video, The Lifestyle Perks Keeping U.S. Gated Communities in High Demand.
What are those perks driving demand? Security. Amenities.
It seems to be a combination. Security is obviously a big one, but also the exclusive amenities, maybe golf courses, clubhouses, private parks, pools, and just that controlled access, the perceived quality of life.
So even in a shifting market, that specific product type holds its appeal.
It appears so, which for agents really points to the value of understanding and marketing the lifestyle a property offers, not just, the square footage and the number of bedrooms.
So the experience, not just the house.
Precisely.
Okay. Any shifts in terms of what people want in a house? Size, features?
Yeah, there's a subtle but potentially significant shift playing out, particularly regarding size. Ion Housing noted on July 25th that the market share of 5,000 square foot plus new homes started declines in 2024.
So fewer McMansions being built.
It suggests that, a potential shift away from the McMansion era. The reasons could be varied, maybe changing preferences towards more manageable spaces, people realizing the higher maintenance and utility costs.
Or just the sheer cost of building something that big now.
That's likely a major factor, too. Rising construction costs make those huge homes prohibitively expensive to build and buy for many.
Interesting. Is there a corresponding trend at the other end of the market, smaller homes?
Well, here's another complexity. Ion Housing also reported on July 21st that sales of lower-priced new single-family homes declined over the past 5 years.
Wait, so sales of big new homes are declining, and sales of lower-priced new homes are also declining?
That's what the data suggests. It points to a kind of two-pronged trend. First, maybe that move away from sheer size we just discussed, but second, the decline in sales of lower-priced new homes. That really indicates a deepening affordability crisis.
It's not just the high end that's out of reach anymore.
Exactly. It suggests that even new entry-level homes are becoming inaccessible for a growing segment of the population. Builders maybe can't even build affordably enough to meet that demand at a price point that works. It leaves a critical gap in the market.
So for agents, what does that mean? Understanding what buyers truly value now.
I think so. Maybe it's efficiency, sustainability, a good location, a finished basement, rather than just maximum square footage. You have to dig deeper into buyer motivations.
Okay. What about demographics? Any standout trends there?
One of the most impactful demographic trends highlighted recently comes from Real Estate News on July 22nd. Boomers now hold nearly 40% of U.S. housing wealth.
Wow, 40%. That's a huge concentration of wealth tied up in housing.
It is. And it has massive implications for future market liquidity. Think about it. These are often homeowners with significant equity, many with paid-off mortgages.
Right, representing a vast pool of potential sellers down the line.
Exactly. When this large cohort decides to downsize, or maybe transitions to assisted living, or eventually passes away, it will unlock a substantial amount of inventory onto the market.
The great wealth transfer hitting the housing market.
You could call it that. So for you, the astute agent listening, understanding the nuances of these boomer clients, what motivates them now, their desire for convenience, perhaps, their financial considerations for their next step, that's paramount.
They're both a current listing opportunity and a future wave of supply.
Absolutely. A critical segment to understand.
Okay. What about the rental market? Anything interesting happening there that affects our listeners, especially those working with investors?
Yeah, the rental market is seeing some intriguing dynamics, stuff that directly impacts investors and maybe even creates, well, accidental landlords.
Accidental landlords, what's that?
CNBC Video on July 23rd discussed accidental landlords starting to impact rental supply. An accidental landlord is typically someone who maybe intended to sell their home but couldn't get the price they wanted.
Ah, so rather than sell low, they decide to rent it out instead.
Precisely. Maybe the market shifted or they had a job relocation and couldn't wait. Rather than selling at a perceived loss, they choose to rent it out, at least temporarily.
And this is happening enough to actually impact rental supply?
Apparently so. While it seems small individually, collectively, this trend adds to the overall rental supply in certain areas.
Interesting. Does it create competition for traditional landlords?
It does. CNBC reported on the same day, July 23rd, that institutional landlords see new competition from an unexpected source, meaning these accidental landlords.
How are they competition? Are they undercutting rents?
They might be. Or they might be less beholden to strict corporate profit margins. Maybe they offer more flexible lease terms or just a more personal landlord-tenant relationship compared to a large property management company.
So it impacts rental availability, pricing, maybe even investor strategies in the rental sector.
Definitely. And it might suggest opportunities for agents, too, maybe offering property management services or advising these new informal landlords who might not know the ropes.
Good point. Okay, lots of micro trends. But what about the big underlying issue, the housing shortage itself? Is that getting any better with all the construction we hear about?
That's the fundamental question, isn't it? And unfortunately, the answer seems to be not really. BiggerPockets had a piece on July 23rd noting that despite a construction boom, the U.S. housing shortage got worse.
Got worse? Even with a construction boom. How?
It means that even with increased building activity, the underlying demand driven by population growth, household formation, etc., continues to outstrip the new supply being added.
So we're building, but we're not building enough to close the gap, let alone catch up from previous years of underbuilding.
That's the assessment. It exacerbates the long-term housing deficit and suggests that while some specific areas might see temporary inventory increases, the overall national shortage isn't going away quickly. Prices are likely to remain supported by this fundamental imbalance.
That's sobering. Anything else on the market data front? Foreclosures, international comparisons.
Yeah, a couple of quick mentions. It's worth glancing at the U.S. foreclosure map you need to see from Keeping Current Matters on July 23rd. Foreclosures remain low historically, thankfully.
Okay.
But it's still another piece of the puzzle, reminding us that distressed properties, though a smaller part of the market now, do represent a segment of potential supply in certain localized areas. Worth keeping an eye on those trends locally.
Makes sense. What about outside the U.S.? Any quick parallels?
Briefly, yeah. Canadian Real Estate Magazine highlighted various things in July. Policy changes aimed at cooling markets or increasing density in places like Vancouver and Edmonton. Grants for accessory dwelling units, ADUs, in Waterloo to boost supply. Insights on multifamily investing in Calgary.
So similar challenges, different policy responses maybe.
Exactly. It shows the parallels, affordability, supply issues, but also the different approaches being tried across North America to tackle these shared housing challenges. Always interesting to see what others are doing.
Absolutely. That's a comprehensive, really detailed look at the market's pulse, from the broad data right down to those critical niche insights. Super valuable.
Glad it's helpful.
Now let's transition. Let's get to the really actionable side of things. What does all this intricate data, all these shifting trends, what does it actually mean for your business, for our listeners?
Right, the so what now part.
Exactly. This section is all about adaptation, strategic growth, and maybe seizing some new opportunities in this constantly evolving landscape. Whether you're a real estate professional or an investor, how do you navigate this?
This is really where we focus on how you can not just, survive, but actually thrive in these dynamic conditions. Because the industry itself, it's undergoing significant structural shifts. Understanding those is key.
Structural shifts like what? Mergers, expansion.
Both. We're seeing continued industry consolidation and expansion. For example, Real Estate News reported on July 26 that Century 21 gains 2 affiliates, and on the same day, eXp Realty lands in Japan.
Okay, C21 growing, eXp Realty going international.
Right. And closer to home, North Texas' largest association, now even bigger after merger, that was reported by Real Estate News on July 23rd.
So bigger players getting bigger, associations merging. What does that signal for the average agent or smaller brokerage?
It indicates that larger entities are consolidating power, probably seeking greater efficiencies of scale and expanding their global or regional reach. For independent agents or smaller brokerages, it signals a maturing industry where scale can matter.
So the pressure is on to either affiliate or differentiate.
I think so. It might urge them to either join forces with larger networks or, alternatively, carve out exceptionally strong, specialized niches where they can really stand out and remain competitive.
Okay. What about the legal and organizational side? Anything noteworthy happening there? You mentioned NAR earlier.
Yeah, on the legal and organizational front, there have been some key developments. Real Estate News on July 26 shared an analysis piece, unfiltered, an easy win for Zillow and Compass suit.
Zillow versus Compass, tech battles.
Exactly. It highlights how these legal battles continue to shape the competitive landscape and define things like intellectual property rights within the real estate tech space. These things have ripple effects.
And NAR, what were they up to?
The National Association of Realtors, NAR, continues to actively protect its interests. Real Estate News reported NAR prevails in Texas mandatory membership case on July 23rd.
Okay.
And also that NAR hires trademark attorney on July 25th. Both of these moves indicate a strong focus on protecting their organizational structure, their membership models, and their brand or intellectual property, especially amidst all the ongoing industry scrutiny and legal challenges they face.
They're definitely playing defense on multiple fronts.
It appears so. And it's not just the traditional players making moves. Look at the big tech companies, CoStar, for instance.
What's CoStar doing? They're huge in commercial, right?
Right. Real Estate News reported on July 23rd that CoStar eyes future revenue stream after blockbuster quarter. They're likely exploring ways to leverage their vast data sets, probably beyond just commercial for new analytical products or services.
More data products, more competition in that space, maybe.
Could be. It could impact how market data is consumed, analyzed, and monetized in the future for everyone. And there's even leadership buzz. Realtor.com's CEO was reportedly in the running for another role, according to Real Estate News on July 22nd.
A potential change at the top there could signal a strategic shift for one of the major portals.
It could. These things are worth watching as indicators of broader industry direction.
Absolutely. So back to the agents on the ground. With all this change happening, what's the core advice for survival and growth, especially if the market is getting tougher?
Yeah, that's the million-dollar question, isn't it? Real Estate News tackled this directly on July 23rd with an article called Playmakers: What Brokerages Agents Must Do to Survive.
Playmakers.
Okay.
Okay, sounds like actionable advice. What kind of strategies are they talking about?
It wasn't just abstract advice. It really delves into concrete strategies for navigating a tougher market. A key theme, likely, is the critical need for agents to pivot.
Pivot from what to what?
From being mere transaction facilitators, just opening doors and writing offers, to becoming true value-added advisors.
Emphasizing expertise, the human element.
Exactly. Emphasizing the unique expertise, the local knowledge, the negotiation skill that you bring beyond what a simple online search or an algorithm can provide, proving your worth.
Makes sense. What about technology? Is it embrace it or get left behind?
Pretty much. The article likely stressed embracing technology not just for basic efficiency, but for enhancing the client experience.
Like what kind of tech?
Think sophisticated CRM systems to manage relationships, maybe AI-powered tools for lead generation or market analysis, immersive virtual tour experiences that save clients time, using tech to provide better service.
Okay, and specialization, you mentioned that earlier.
Huge. It highlights the importance of developing a niche specialization, whether that's focusing on luxury properties, first-time home buyers, specific geographic micromarkets, or maybe serving investor clients exclusively. Become the go-to expert for something.
Don't try to be everything to everyone.
Especially not in a more competitive market that's often a recipe for mediocrity.
Got it. Any more practical, hands-on advice coming out, like how to actually get more business or engage clients better?
Yeah, some very practical stuff, too. Decoded: 5 things brokers can do to increase walk-in traffic, from Real Estate News on July 21st.
Walk-in traffic. People still do that.
Apparently, there's still value there. The article likely suggested strategies like, hosting community events at your office, creating a visually inviting storefront, partnering with local businesses for cross-promotion.
Building local presence.
Exactly. Offering free educational workshops for buyers or sellers. And just ensuring you have a strong local online presence, Google My Business, etc., that actually guides people to your physical location if they are looking.
Okay. What about marketing, especially in different market segments?
Technology is changing that rapidly. How tech-driven marketing is changing luxury real estate in small markets. That was on the RIS Media blog on July 22nd. RIS Media.
Tech in luxury, even in smaller towns.
Yes. It points to the increasing sophistication required everywhere. For luxury clients, even in smaller markets, this means leveraging things like high-resolution drone photography, professional videography, maybe virtual reality tours.
High production values.
Definitely. And highly targeted social media campaigns to reach affluent buyers wherever they are. For smaller markets generally, it emphasizes hyper-local digital campaigns.
Hyper-local meaning.
Focusing on unique community aspects, the lifestyle, local businesses, the schools, connecting buyers emotionally to the place, not just the property specs, using digital tools to tell that local story.
Makes sense. Now, one specific challenge agents often mention is connecting with younger buyers, like millennials. Any insights there?
Yes, that's a recurring theme. Realty Times on July 24th published Ghosted: 3 reasons why you're not closing millennial buyers.
Ghosted. Ouch. Why are agents getting ghosted by millennials?
The article likely delves into specific generational differences or preferences. Things like their expectation of digital-first communication. They might prefer texting or email over spontaneous phone calls.
Okay. Meet them where they are digitally.
Right. Also, understanding their financial realities, many are dealing with significant student loan debt or haven't had as much time to save for a down payment. So transparency about affordability and total costs is crucial.
No surprises.
None. And they rely heavily on digital tools for every step of the process, from initial research online right through to maybe e-signatures at closing. They expect a seamless tech experience.
So the remedies are likely about adapting communication styles, being upfront about finances, and leveraging tech to simplify the whole process.
That's generally the advice. Make it easy, transparent, and digital-friendly for them.
Good tips. And underlying all these strategies, what's the foundation?
Integrity. Always. Realty Times had a piece on July 23rd asking, how important is integrity in business? It sounds basic, but it's a reminder that trust remains absolutely paramount.
Especially in a competitive market.
Especially then, discerning clients value honesty, transparency, and knowing their agent truly has their best interests at heart, above everything else. That builds loyalty and referrals, which are gold.
Absolutely fundamental.
Oh.
Okay, that's incredibly insightful for agents and brokerages navigating the current landscape. Shifting gears slightly, but still related to industry dynamics, what about those disruptive forces like the iBuyers?
Oh, yes, the iBuyers, Opendoor, OfferPad.
Are they still a significant factor in the market? And what are their strategies looking like right now, especially given all the market shifts we've been discussing? Are they adapting?
They are definitely still a factor, yes, and they are absolutely adapting. iBuyers continue to be this dynamic force, maybe a bit unpredictable, but certainly present, and they face their own set of challenges and are constantly evolving their strategies.
How are they evolving? What's new?
Well, look at Opendoor. Real Estate News reported on July 24th that Opendoor looks to entice sellers with bonus cash after resale.
Bonus cash after resale. That sounds different from their usual model.
It is. It's a potentially significant strategic shift. Historically, the core iBuyer pitch was all about convenience and speed, right? Get a quick, hassle-free cash offer, avoid showings, close fast.
Right. Certainty over maximum price, basically.
Kind of, but this bonus cash after resale idea, it indicates they're trying to add another layer. They're attempting to differentiate themselves and provide potentially more financial value to sellers beyond just the initial convenience.
How would that work? They sell the house for more later and share the upside.
That's likely the concept. Maybe sharing future appreciation if the market moves up after they buy it, or perhaps guaranteeing a minimum total return to the seller after the property is resold on the open market.
Interesting. So they're moving beyond just convenience to compete more directly on potential financial outcome for the seller.
It looks that way. It's a clear signal they are adapting their business model to attract more inventory, especially now that sellers might have more traditional options and they need to compete harder with traditional agents for those listings.
Okay, so strategically they're adapting. But what about their actual performance? We hear conflicting things about their stock prices and financial health.
Ah, yes. Their market performance has been, well, let's call it volatile, extremely volatile. It really reflects the inherent risks and the somewhat speculative nature of their core business model.
Volatile how? Give us an example.
Okay, get this contrast. CNBC reported on July 22nd that Opendoor leads meme stock redux on Wall Street with shares tripling in 1 week.
Tripling in a week. Meme stock territory. Wow.
Yeah, it suggests a period of significant, maybe speculative investor enthusiasm, perhaps driven by day traders or a renewed belief in their long-term potential, or maybe that new bonus cash strategy got people excited.
Okay, but you said contrast. What's the other side?
Well, just 1 day earlier, Real Estate News reported on July 21st that Opendoor stock leaps amid NASDAQ delisting concerns.
Wait, delisting concerns? As in potentially getting kicked off the stock exchange? How can both be true almost simultaneously?
Exactly. It highlights the extreme volatility and the precariousness sometimes associated with these stocks. The delisting concerns would typically stem from the stock price consistently trading below the minimum required level for a NASDAQ listing, which usually indicates underlying financial vulnerability or market skepticism.
So 1 minute there's worry about getting delisted, the next minute the stock triples like a meme stock.
That's the kind of wild swing we saw reported.
What does this dramatic up and down performance tell us about the iBuying business model itself?
It tells us a lot about the underlying economics. Their model is incredibly capital intensive. They have to buy homes, often with their own cash or significant lines of credit.
Right, they own the inventory.
And then they need to renovate them, potentially, pay holding costs, taxes, insurance, utilities, and then turn them over relatively quickly for a profit after accounting for all those costs plus their service fees.
So their profit comes from the fee plus any appreciation they capture.
Primarily, yes. The transaction fee and accurately predicting short-term property appreciation are key. It's not just about sheer volume, it's about margin on each deal.
And that makes them very sensitive to market shifts.
Extremely sensitive. When the market is stable and prices are consistently, predictably appreciating, their model can work well, even thrive. But when prices fluctuate unexpectedly, or if properties sit on their books for too long because the market slows,
their holding costs eat into profits, and they risk selling for less than they anticipated.
Exactly. Their profitability gets severely stressed very quickly, which is why their stock is so volatile. Their financial health, and thus their stock performance, is directly tied to short-term market stability and their ability to efficiently turn over properties.
So for our listeners, the agents, what's the takeaway on iBuyers? Still a threat, an opportunity, a fragile competitor?
Maybe a bit of all three. It's a reminder that while iBuyers are a part of the landscape, and they offer a unique selling proposition based on convenience that appeals to some sellers, their stability and their market influence can shift really rapidly.
So understand their current strategies, like the bonus cash offer.
Yes.
But also be aware of their financial health and the volatility, because that affects how aggressively they can compete, or even if they'll be operating in your market long term.
Precisely. It's key to assessing them accurately, whether you see them as a competitor for listings or maybe even as a potential quick sale option for certain clients in specific situations. Knowledge is power here.
That volatility is certainly something to keep a very close eye on then,
Right.
both for understanding the competitive landscape and, like you said, for advising clients appropriately.
Definitely.
Okay, now let's shift our focus again. Let's talk about investment strategies and how our listeners, as agents, can best advise their clients.
Right. Whether those clients are seasoned investors just starting out or even regular homeowners looking to maximize their property's value or make smart decisions.
Exactly. This is where you, the agent, can bring really actionable knowledge to the forefront and demonstrate your value.
Absolutely. This is a huge area where agents can add immense value beyond just the transaction. And there's a ton of great content out there aimed at investors particularly.
Like from where? Bigger Pockets seems active here.
Oh, consistently. Bigger Pockets really delivers valuable, actionable information for investors. For example, in the past week, we saw articles like Best Short-Term Rental Market in Every State.
Okay, is that just a list or does it offer more?
It's more than just a list. It usually delves into the criteria that make a market ideal for short-term rentals. Things like tourism appeal, favorable local regulations or lack of restrictions, average daily rates, occupancy rates. It helps investors target potentially the most profitable locations.
So data-driven guidance for STR investors. Nice. What else?
Another one was how single-family home data can reveal key ROI insights for investors. This goes beyond just looking at purchase price.
Getting into the nitty-gritty numbers.
It's exactly. Guiding investors to analyze crucial metrics like accurate rent comps, local vacancy rates, estimating operating expenses, calculating capitalization rates, cap rates, to truly understand a property's potential return on investment before they buy.
Essential due diligence for investors.
Absolutely. They also highlighted specific markets, like in why Dallas is a hot market despite high prices.
Why is it hot, even with high prices?
The article likely explained the underlying economic drivers, maybe strong job growth, major corporate relocations moving headquarters there, significant population influx.
Yeah.
Those fundamentals can sustain demand and rent growth even in a higher cost environment. Understanding the why behind a market is key.
Makes sense. What about finding deals? That's always tough.
Yeah, and for investors looking to get an edge, Bigger Pockets had an investor's guide to finding off-market properties.
Ah, the holy grail, off-market deals. How do they suggest finding them?
It provides practical methods, things like networking heavily with wholesalers, contractors, other agents, using targeted direct mail campaigns to specific neighborhoods or owner types, searching public records for probate leads or pre-foreclosures, even old-fashioned door knocking or driving for dollars, trying to uncover deals before they hit the open market and face bidding wars.
Good practical tips for the motivated investor. What about advice for landlords after they buy?
Crucial area, too. Understanding the nuances of landlording is key for long-term profitability and minimizing headaches. Bigger Pockets had a piece on understanding and evaluating normal wear and tear in rental property.
Oh, that's a big one. Security deposit disputes often hinge on that.
Exactly. This provides essential guidance to help landlords avoid disputes with tenants when they move out and correctly assess what's actual damage versus just normal aging of the property. Knowing the difference saves money and legal trouble.
Good point. Anything else for landlords?
Knowing starts where tenant retention is highest, another Bigger Pockets insight. If you know tenants tend to stay longer in certain markets,
That means lower turnover costs, fewer vacancies, potentially higher ROI.
exactly. It allows investors to strategically choose markets where they might minimize those costly vacancies and tenant turnover expenses. It's a factor to consider.
Okay. Any buzz about creative financing? That always gets attention.
Always. There was an article on Bigger Pockets, July 23rd, How I Funded a Flip with $0 out of pocket.
$0 out of pocket. How?
These articles often involve leveraging things like private money lenders, individuals lending money based on the deal itself, or using hard money loans, which are asset-based, maybe structuring strategic partnerships where someone else brings the capital. The point is exploring ways to minimize the upfront personal cash needed, which can allow investors to do more deals.
Interesting. Lots of options beyond traditional bank loans for investors. What about different types of properties to invest in?
Yeah, good question. Canadian Real Estate Magazine, interestingly, offered insights comparing different approaches. On July 22nd, they looked at the pros-cons of turnkey properties.
Turnkey meaning already renovated, maybe already tenanted.
Usually, yes. The pros are convenience, immediate rental income potential. The cons are often a higher purchase price because you're paying for that convenience, which could mean a lower cash-on-cash return or ROI.
Okay. What else did they compare?
On July 21st, they looked at the pros-cons of pre-construction, buying before it's built.
What's the appeal there? Locking in a price early, customization.
Those are the potential pros. Locking in today's price for future delivery, potential appreciation during the build phase, choosing finishes. But the cons are significant risks.
Like what?
Construction delays are common. Market shifts, prices could fall before completion. The builder could go bankrupt. Financing could change. Lots of variables when you're buying something that doesn't exist yet.
Definitely requires a different risk tolerance. Any other property types discussed?
Realty Time is also discussed. Does buying and living in a duplex make sense? That classic house hacking strategy.
Right. Live in one unit, rent out the other to help cover the mortgage.
Exactly. Exploring that owner-occupant investment strategy. So these discussions help you, as an agent, guide clients toward the investment vehicle turnkey, pre-con, duplex, single-family rental that best suits their specific risk tolerance, capital, and financial goals.
Great overview for the investor side. Now, what about homeowners? What practical guidance can agents relay to their regular buyer and seller clients based on recent articles?
Tons of practical guidance there, too. Really essential for agents advising clients. Realty Times outlined the top 5 plumbing expenses homeowners face.
Oh, good one to know. Why is that useful for agents?
Well, you can proactively warn buyers about potential big-ticket future costs associated with older plumbing systems during a showing, or advise sellers on necessary pre-listing repairs to avoid inspection issues related to plumbing. Saves deals later.
Smart. What else from Realty Times?
They also offered tips for redecorating while on a budget. This can be invaluable for seller clients looking to make their home more appealing staging, basically without breaking the bank before listing.
Or even for buyers after they move in, to help them envision the space.
Exactly. And specifically for selling, understanding how to handle lowball offers is crucial in a market where buyers might feel more empowered.
Right. Don't just get offended. Have a strategy.
Have a strategy, like countering effectively with recent comparable sales data or understanding the buyer's motivation. Also, practical stuff like preparing your home for hurricane season, essential advice for homeowners in vulnerable areas.
Timely advice for sure.
Yeah.
Any other selling tips?
Keeping Current Matters on July 21st had articles like staging tips for selling to specific target markets.
Tailoring the staging, not just generic decluttering.
Right. It might involve decluttering and depersonalizing for a general audience, sure, but maybe also creating specific functional spaces that appeal to likely buyers, like staging a spare room as a dedicated home office if you're targeting remote workers or millennials.
Smart. Know your audience.
And they also had, don't make these mistakes when selling your house. Classic advice, always relevant, avoiding overpricing, poor photos, not preparing the home properly, being inflexible with showings. These equip homeowners via their agent to protect their asset and optimize their selling position.
Great practical tips for agents to share. Lastly, what about technology? You mentioned AI earlier. Anything else on the tech front relevant to agents or investors?
Yeah, technology continues to fundamentally transform both construction and real estate operations. Staying abreast of these innovations really offers a competitive edge.
We heard about builders using AI. What else?
Ion Housing on July 23rd highlighted that builders' use of artificial intelligence. It indicates growing adoption of AI for everything from optimizing construction schedules and supply chains to predictive analytics for housing demand, maybe even generative design for floor plans.
AI is touching everything.
It really is. And then there's the REACH commercial scale-up cohort announced on Geek Estate blog on July 25th.
REACH, that's the NAR-backed accelerator, right? What's new there?
This announcement showcases significant innovations, specifically in commercial real estate tech. They're nurturing companies that are bringing potentially transformative solutions to areas like property management, leasing platforms, investment analysis tools for commercial properties.
So innovation continues strongly in the commercial tech space, too.
Definitely. And sometimes seemingly niche applications show broader trends. CNBC mentioned Butler BUTLR body heat sensors for office efficiency on July 22nd.
Body heat sensors for offices. Why?
To anonymously track how office spaces are actually being used, which desks are occupied, which conference rooms are popular. This data helps companies optimize their real estate footprint, maybe redesign layouts for better collaboration, or save on energy costs for unused areas.
Oh, using data to make commercial real estate smarter and more efficient.
Exactly. And the point is, these advancements, whether it's AI in building or sensors in offices, they aren't just for the giant firms. Understanding these trends can give agents and investors a significant competitive edge by allowing you to advise clients more intelligently. Maybe about incorporating smart home features for resale value, understanding energy efficiency trends, or even advising on the future-proofing of commercial property investments based on how technology is changing space utilization. It adds another layer to your expertise.
Fantastic. That's a truly comprehensive deep dive into the strategic side, covering so much ground.
Hope it was useful.
Incredibly useful. Okay, so we've covered a lot today. We went from potential tax policy shifts and the Federal Reserve's steady hand on rates through the surprising nuances of market supply and demand, that whole inventory versus price puzzle. And finally, we landed on practical, actionable strategies for real estate professionals and investors alike, covering everything from industry shifts to tech adoption to client advice.
Yeah, we really unpacked a lot from the past week's news flow.
So let's try to synthesize it. What's the main takeaway from all this for our listeners, the pros in the Wire community? What they should walk away with?
I think the main takeaway, boiling it all down from this past week's news, is pretty clear. We are navigating a market of, 1, increasing inventory in many areas, and 2, increasingly nuanced price dynamics.
Nuance meaning not straightforward.
Exactly. This isn't a simple buyer's market or seller's market anymore, not uniformly anyway. It's a dynamic, highly localized landscape. And in that landscape, understanding client leverage, whether it's buyers gaining some power or sellers still holding strong in certain segments and adapting your advisory role, is absolutely paramount.
So the agent's role becomes even more critical as an advisor, not just a facilitator.
More critical than ever. This shift means you need to prioritize strategic selling, moving beyond just passive listings to really proactive marketing, smart pricing, and skilled negotiation.
And on the buy side?
You must be adept at finding creative solutions for buyers who might be struggling with affordability, while also guiding sellers who might still be hesitant to list due to that lock-in effect or market uncertainty.
And underpinning all of that, staying informed.
Critically, yes, you have to constantly stay informed on both the broad economic policy shifts, like that potential tax change or Fed moves, and the rapid advancements in emerging technologies that are reshaping how we do business.
So, being the best version of themselves, as we sometimes say, in this environment means what?
It means being adaptable, first and foremost, being resourceful, truly understanding the granular data, not just relying on the national headlines, and using that deeper knowledge to empower every single client interaction, providing real, tailored advice.
Couldn't agree more. It's about elevating the profession through expertise and adaptability.
Well said.
And that brings us perfectly to our final provocative thought for you, our listeners, to maybe mull over as you go about your week.
Okay, let's hear it.
Given the current policy discussions we talked about, specifically around capital gains tax potentially changing, and the evidence of increasing buyer leverage in at least some market segments, how might these two potent factors, a potential new incentive for some to sell, colliding with more powerful buyers, how might they combine to reshape the very definition of a good deal for both buyers and sellers in the next, say, 6 to 12 months?
Interesting. Reshape the definition of a good deal.
Yeah. And crucially, what new, perhaps unexpected opportunities might that dynamic create for savvy agents like you who truly understand these fundamental shifts and are ready to adapt your strategies accordingly?
That's a great question to ponder. How value is perceived and negotiated could definitely change.
Something to think about as you navigate the weeks ahead.
Definitely food for thought.
Well, thank you so much for joining us on this deep dive into the latest real estate currents. We sincerely hope these insights are not just informative, but truly valuable.
Yeah, hope it helps you make sense of the noise out there.
We hope it helps you navigate the market with even greater confidence and hopefully a stronger strategic advantage. Keep learning, keep adapting, keep applying these insights to your business right there on the front lines.
Stay sharp out there.
And we look forward to our next deep dive with you very soon.
If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, The Week in Real Estate. Thank you for listening.